Good afternoon, colleagues. My name is Jakubose Sibanda. So I'll be just presenting on stock market integration, considering a case of South Africa and G7 countries. I think I must hasten to say this is incomplete work. It's something that I just analyzed, and I had to do a write-up so that at least I can present something. Based here in Cape Town, so ORSSA couldn't just come and go without me coming to the presentation. So I'm actually an operations research analyst by training, and then I ventured into finance a little bit, and I'm hoping that probably I'll also apply a lot of operations research techniques in finance. Okay, so as we know, there is a lot of financial market integration, probably as a result of technological advancement and deregulation of capital markets. You'll understand that, long back, we used probably to have just one market, and it was a physical market. But nowadays, there are a lot of electronic platforms where people can trade. So all those kind of things, they've increased financial market integration. Also, trade, international finance and trade, all those kind of things have also advanced the financial market integration. In 2002, it is recorded that 7% of equity allocations came from advanced economies into emerging markets. But in 2012, it was recorded that about 20% of equity allocations moved from the advanced economies into emerging markets. So linkages between markets has increased synchronization of asset prices movements. So it's now difficult for people probably to have to be arbitrators because markets are now synchronized. Linkages emanating from trade. So they say trade consists of about 10 to 20% of equity integration between emerging markets and advanced markets. So you find out that someone who's sitting anywhere in the world and they want to make an investment decision, they will have to probably incorporate information that they have within their local country and also outside as well, because whatever that is inside will be influenced by what is also outside. So global equity integration affects effectiveness of monetary policy. So we need to study this because eventually that is what influences what happens in the monetary policy sphere. Monetary policy responds to movement in stock markets. Integration also plays a role. So integration has got some benefits and also it has got some risks. So it is important to study it because you can actually, it's a double-edged sword. So you can actually gain and you can also. So recent COVID-19 has also induced a distress in financial markets, and it has also promoted, raised the excitement again in these kinds of research because of the COVID-19. So what drives financial integration? So one thing that is raised in literature time and again is trade linkages are the ones that are important in transmitting financial spillovers. Bilateral trade flows have caused significant leakages in stock markets. That effect has increased since 1996. Some attribute this maybe to other factors such as economic growth that is booming, but I find that the issue of trade linkages is mainly mentioned in literature. Cash flows of countries, if you consider a company, its cash flows are also linked via trade activities that it has, and therefore equity markets as a result are integrated. The level of integration between markets is fundamental to different categories of investors. Among them are hedgers, speculators, and arbitrators. So if you are an arbitrator, so it means you wouldn't want markets to move together because you want to get to the other side before the price changes, isn't it? But if you are a speculator, you actually play in the volatility space. So if the markets are co-moving, you're actually interested in that kind of a space because you can actually profit in that sense. So co-movement across time and frequency play a crucial role in trading strategies. So we need to understand what is happening in the time and domain frequency to say, okay, when we've got high frequency data, what is happening? When we've got medium term data, what is happening? And when we've got long term. So because we've got different kinds of investors that are affected by different kind of trading strategies that they might be having. So the understanding of trading behavior at different points in time can also help information dissemination and price discovery. So if I want to know what is happening in South Africa, the price of equity here in South Africa would definitely be affected by whatever that is happening somewhere else. Okay, so in this study, I tried to think of South Africa and the G7 countries. Why did I choose South Africa and G7 countries? You see that some studies actually identify South Africa as being affected so much when there are spillovers. For instance, in 2018, there was actually a drop of about 40% when there was a financial crisis. So there was actually a drop of 40% in the stock market exchange, Johannesburg Stock Market Exchange. So some people also record that it was the lowest, it actually reached the lowest point in 17 years. And there were actually a lot of job losses during that time as well. Some other studies also mentioned that South Africa is one of the preferred destinations by investors. So it acts as a leader, mainly in South Africa, in Africa. So you find out that South Africa is actually a much well-developed in terms of its stock market in comparison to other countries in Africa. I think next to it, probably that could be Egypt. Yeah. So why did I choose G7? So G7 is one of the powerful, sectors or a segment in the world that has got a lot of contribution into the global wealth. You see that in G7 made up of about 58% of global net worth. That is about 317. That's in 2020. Considering nominal values figures, constitute more than 46%. So actually, whatever the activity that is happening in the world in terms of the economy, these studies are actually saying that G7 contributes about just slightly below half of world activities. Yeah. So it is actually a very important, part to study. So these are just some statistics between South Africa and G7 countries. So if you add all the G7 countries, you'll find that from 1992, the trade, South Africa in terms of its trading, it was actually trading almost 60% of its trade was with G7 countries. So G7 countries are very important to South Africa. So in other words, what happens in G7 countries, there's a likelihood that it would affect whatever that is happening that other side. But we see that, okay, amongst all these other charts, you can see that, okay, Canada is one of the lowest in terms of trade. The other countries that we never mentioned probably in this study was China. China is also one of the, the biggest trading partners of South Africa as well. In terms of export, you can also see that, okay, at some point, we're actually exporting 50% of our goods to G7. Okay, so studies have been conducted in the area of financial markets, coherence and connectedness, particularly amongst developed markets. But we find out that in the developing markets, there hasn't been much in terms of that has been done. Higher interconnectedness among financial markets conveys both benefits and risks. The understanding of connectedness would positively enhance the risk sharing in various degrees of absorption by individual asset and can provide benefit of diversification for weakly connected assets. So South Africa is struggling a better understanding of how financial markets operate can enhance the growth of the economy. I'm sure that's not properly formulated, but hopefully we'll get some feedback. So the aim of the study is to gain a comprehensive understanding of the nature of integration levels between South Africa and the advanced economies through various financial crisis periods that have happened in history to the most recent, which is COVID-19 catastrophe. We undertake this study from the perspective of stock markets integration through the application of the time frequency domain. So the objective of the study, we just applied two techniques. So the first one is going to be looking at South Africa and each other country, which is in the G7. So we are going to use a bi-wavelet coherence technique. And then number two, we're going to examine the multivariate co-movement. So we're going to combine all the countries and obtain an overall level of integration between South Africa and G7. And so in terms of literature, some of the early studies, seminal work by Grumbel. So it also points to the point that Portfolio International hinges primarily on the correlation between two countries. So we have to consider South Africa and other countries. Are there any diversification benefits between those countries and South Africa? Some studies also employed techniques like the time-varying parameter vector autocorrelation to empirically analyze volatility spillovers effect of the BRICS. Their results, I just took South Africa because that was what we are interested in. The results indicate that all other countries except South Africa. Actually, South Africa is the only net receiver of volatility. I think there was a mistake there. So South Africa is the only country that is a net receiver of volatility. Then some other studies also studied US and BRICS using the wavelet coherence. And South Africa showed the highest degree of co-movement at higher frequencies. So some other studies also looked at BRICS and US. The findings suggested that the co-movement at both high levels and low frequencies. So these are some of the recent studies. So some applied these techniques in the REITs, real estate investments, trust. Some applied them in commodities, in gold. Some applied them in cryptocurrencies. But I find out that there hasn't been much that has been done in terms of South Africa, since it's one of the leading economies in Africa. So some of the old theories and some of the more recent theories, the modern portfolio theory, the international portfolio theory, modern monetary theory. So we've got adaptive market hypothesis that mentions that financial markets decisions are always affected by the behavior of investors and various kinds of investors, and also market conditions that change. So people will need to adapt to what is happening there. So heterogeneous, these are different kinds of investors and how they behave. So we want to try and test some of these theories. Then there's the more recent one, which is the competitive market hypothesis, to say with the dynamic changing of markets that is happening, people try and look for competitive places where they can actually put their investment, looking for competitive risk opportunities. Okay, so in terms of the methodology, we are going to use the continuous Mollet wavelet transform, that is by Mollet, 1982. It regards, so in this case, it's more like an integral transformation. So we're trying to transform a series, which could be xt, into different kinds of scales in moving positions. So the scales, you have already mentioned that the scales are going to be more like the low frequency, medium frequency, and high frequency. So low frequency can be something that is in terms of long term, so that can be even more than 3 years going forward. But when we say high frequency, that becomes more like 2 days, 4 days, or even 2 weeks or so. So that was done by In Kim in 2013. So that is just a one-time series variable that you just transform into a wavelet. So why do we use wavelets? We use wavelets so that they can be able to give us time information, and then they can also be able to give us the frequency information as well. But if we've got 2-time series, then you can apply second one, which was given to us by Grossman Mollet in 1984. Then the Mollet wavelet can be simplified as that, where your omega is a non-dimensional time parameter. And then you also have got these two transformations, Wx and Wy, and then they give us this this equation below, which is the covariance. But the covariance doesn't really state to us exactly what is happening. So this guy, Roche, 2014, came up with a technique which is called a wavelet technique. So they amplified this one, which uses the phase differences for us to see what is happening, so that we can actually be able to see which market is leading and which market is not leading. So wavelet power spectrum is challenged regarding assessing the degree of integration of the two series, which is solved by Roesch and Schema 2014. Similarly to the radiation correlation coefficient, the wavelet coherence is the local correlation coefficient in time series and space. Okay, so this is the wavelet multiple correlation. It brings everything together. The first one, we're just doing those countries in pairs. And then the second one, we're now combining everything. This is more like a linear regression. So we are trying to find a variable that would maximize the linear combination of all those other variables that we would have put in there. So then this one will then give us the one variable that maximizes everything. So we've got a correlation, covariance, and then we've got a variance. So the same way that we do when we are doing a simple multiple regression, where we are trying to find the highest coefficient determination that maximizes this. Okay, there are also further readings that I recommend for this. Okay, in terms of our data, so we just took the stock market exchange data for the dominant exchange in that country, the biggest exchange in that country. So we know that for South Africa, it was the Johannesburg Stock Exchange, but for US, it was the S&P 500. So we can actually see that from South Africa, we actually get probably the highest in terms of the mean, in terms of the return. But in terms of the risk, we can actually see that South Africa is more riskier as well. So they're all negatively skewed. We don't have to mind whether the data is stationary or not, or non-stationary. We will just, the wavelet will just take care of all those allowances in terms of the statistics. I don't know how much time I have. Okay, so this is just the description of the data. We can actually see, so I took the data from 2000 until recently. So we want to always keep our models. I'm left with 2 minutes. So we always want to keep our data up to date. So we can actually see that, okay, between the American countries, America's countries, you can actually see that, okay, there's a bit of a lower correlation in the American countries, but in the European countries, we can actually see that there is, it actually starts from 0.5. There's actually a bit of a higher correlation as compared to the Americas countries there. So this is a wavelet transform. I don't think I might have time to interpret this. But when you are interpreting this, you've got a cone of influence. There's just a curve that is there. And then when you are interpreting this, you have to look at the contours that are inside and then be able to interpret so that you can be able to find, you know, places where there have been fluctuations in the data. So this is the wavelet coherence. So you need to predict the arrows so that you can actually see which market influences which market in that sense. Okay, so this is the last slide. So this brings everything together to say, okay, when we consider all the markets, we'll find that, okay, France is always leading or lagging in terms of all the markets. So I also had to remove France so that we can see that, okay, which other market would be leading besides France. Actually, we actually see that South Africa, you know, it concurs with many other studies that South Africa is now very much integrated with the world, you know, but that still means there are benefits within. So we need to be very careful on what happens, especially in G7 countries. So in terms of conclusion, we modeled the co-movement of stock markets between South Africa and G7. We find out that there exist low degrees of integration between the markets and the higher frequencies, but this goes stronger at medium and perfectly integrates at lower frequencies. Speculators may actually garner gains from the integration of markets. The first difference arrow, or the arrows that I was showing you, G7 are net transmitters of spillover effects to South Africa. Findings of high-level integration in medium and long-term provide insights for regulators and potential international investors. So for future studies, I would recommend that probably we study this again, but we only consider probably the sector stocks, you know, so where we can actually find where the risk is coming from, because now I was just using stock market data. So that is aggregated data, but we might not actually know where the risk is coming from. So if we disaggregate that data, we can then be able to know where it's coming from. I think that's fine. I'm sorry I had to rush through the presentation, but thank you so much.
Any questions? I've got many. If anyone doesn't want to ask, and then
I'll ask one question, please. Okay, so help me understand this. In measuring the integration between these developed markets and the emerging markets, you predominantly used imports and exports as a measure.
No, I never used any of that data, but I was trying to motivate the study to study the stock markets, because in literature they are saying that stock markets will be integrated, you know, if there is high trade volume or if there is high activity in trade.
Okay, so use trade as your measure in formulating the study.
No.
The question I'm getting to, would you consider something like the gross fixed capital formation as a measure itself in measuring or trying to model integration between these markets as an alternative?
It's possible, but this study was not looking at those other variables. It was only looking at the stock market.
Yeah.
You know, so we could have looked at probably if we could have had more time, we could have actually incorporated the minor trading partners and the major trading partners to see whether there is something that we can infer. So we are trying to develop something that will infer stock market and trade linkages. Yeah.
So I think a little bit of information for you, those of you that are a bit late coming in. I think our next speaker is actually not here. So I'd like to give everyone an opportunity, if you would. He got stuck at a border, they wouldn't let him through his visa. So it's like I was saying earlier, best reasoning ever. If you'd like to hop across and attend one of the presentations on the student side, you're more than welcome to. So you've got just enough time to get there, squeak in, but then come straight back. Don't get pulled in by the allure of the right decision to be here in the finance side. Or if you'd like to just chill out and have a chat with your colleagues here about money or something else, I've got more questions. I'd love to understand how to interpret those plots. You're also more than welcome to stay, and we can give Mr. Sibanda here a bit more time. Otherwise, your call. I'll be here either way. So yeah, opportunity if you'd like to go. Thanks again. My question was going to be, how about you can start it with the notes?
Scale.
What are we finding like these hotspots?
So you see, this is 2004, 2008, 2016. There was some 18.
So we're going to finish the.
Are you? Sorry, I don't know if you missed that. You must want to listen in on how to.
No, I mean, yeah, so you have to interpret this concept I wanted to hear you. Fine. I mean, we said, remember, we said this is 2008. So in 2008, these fluctations happened in the scales. So in the sequence data.
Okay, so are you saying when you say fluctuation, just the line between different exchanges in a high frequency?
Yeah.
So like if I were to look at the period here, a higher frequency, low frequency correlation.
Yeah.
Okay, so this is arbitrage. This is stability over here.
Yes, this is stability over here.
Okay. Sorry, I came in a little bit late. Can you explain that?
Oh, no, but
Okay, so this is just a continuous oblet.
Okay.
So it shows you the time. So I couldn't put the units here, but this is 2004, 2008.
Okay, so let's take 2008 as an example. So I guess I draw a line here to analyze what happened in 2000.
So when you see this,
The instant.
so when you see this whole diagram, the only things that you have to interpret are things that are inside here. And then when you come inside, you only interpret the things that are in the circles. So when it's too dark here,
Yeah.
it means that there was high intensity, but this high intensity happened in the mostly daily data or weekly data,
Okay.
2-week data.
So your low frequency here, so it's a high frequency here, and low lag times here. So this is your period of this axis over here.
Period for your return calculation. Okay.
Like your frequency.
Yeah.
So this is actually going to be my first question, right? In case no one asked, but when you say you're measuring the trade, you've got a high open close for whatever time scale you want. How are you measuring the unit of trade for an entire exchange? Are you looking at the trade volume? Are you looking at the trade direction? Are you looking at the value of the stocks in the exchange?
So this sorry, I don't see. So this is just a description of it. This really doesn't tell us anything. So this part here, it's what is happening in the daily data. So where are the fluctuations emanating?
Yeah, but okay, your input in studying this whole thing is the index value, right?
Yes.
So the index for the exchange.
Yes.
Okay. Yeah, no, perfect. Sorry. When you stocks, I thought some sort of individual.
Presenting this here or not? Is it?
No.
It's
It's not like you didn't look at this. You can also, you can look at the sector. He said that earlier. So what he's now looking is country. That's my understanding.
Yeah.
Using the indices.
Using
The
the
JC index. It's 40 or the 196 or whatever.
everything. Everything.
I'm just like spending time in it.
Just take everything.
Well, I mean, I'm highly concentrated.
It's.
But this here, right? So the top is the, what does it mean to have the dark part versus not having a dark?
This.
So This part here, it's low correlation here. Correlation, but here there's high correlation, there's high intensity.
Okay, so in this period there was high intensity, but this period there wasn't much in the high frequency. So daily data wasn't highly volatile, but here, okay. And what is
I was going to go now.
medium?
This one actually shows us that around about 2007, where the financial crisis
What countries did you go to?
so it was actually fluctuating.
So 1 week or something like that.
There was fluctuations, but where
Yeah.
of frequency.
Which is like monthly or something.
Yes.
And is this continuing?
Yes, this is correct.
Okay, so you can ask something.
Extensive, and you said you were 3 months.
Very interesting.
Do you have like relatives or friends there? Would you like bounce between the hostels and things? But sure, awesome. Was that 2019 that? Back home, just ask COVID. Just like was the, yeah. And then since then, what have you been up to?
So this is the correlation and the covariance. So like what you do on your equation. You've got your actual values, substituted values. So you're trying to find
Yes, yeah.
pills.
Awesome, man.
Here, this looks like a correlation.
And the type of work that you do.
But you're trying to look for that it's a combine of everything.
Yeah.
Yes. So then you're trying to that way. So it's the coefficient multiple correlation.
So very different to what you were doing.
Yeah, so this one is here. So we're trying to
Yes.
Formula.
what do you mean?
Yes.
It's like fish.
Yes.
I really like this.
This one was
Send this to.
done by Machos.
No, because I just
Like I was giving him
And this Macho.
then you had into those back from Pretoria.
another
If
picture.
you just grew up, yeah. Okay.
Everybody's just listening. But the camera that they use, right? So amazing. You can see the movements of my face.
Yes. Do this.
Do you think they I like this picture here because I'm talking, but it's about the school with the global impact.
For sure. For sure.
The thing stressed me out. But anyway, it's
I'm
done.
gonna ask what the development language is that they're using for the
Go back with an exam.
and when you like the I went so directly to the finance.
I'm going to find
We just came back from the holidays.
No, we're gonna do our own thing now, yeah.
So in the beginning.
Yes. You get anticipated all of those things. Yes.
I mean, I just chatted to him on Teams just now.
Yes.
His visa was rejected or something. He's getting now
rest of the business of
The piece.
Yes.
Figure it out.
The data line.
It's such a big risk for the user, especially the risk for the programming. It's already, I think, overloaded, so I can't imagine how it can manage. I mean,
How the heck did you pull that off? This like a day before. Yeah. I had to run and go home, and then the following afternoon at 4 o'clock it would be ready. Delicious.
Oh, yeah. The sick. We don't think anything for the sick.
Excellent. How were the student competition speakers? Student talk? Anyone go? Ozani, how was it? Nice. I think we should open a betting pool to see who won. Just run like a side hustle, and we can, because this is the finance section, we can all trade in futures effectively. So we can offer, yeah, stabilize the whole thing, make sure we net out a zero position, and then make some arbitrage along the way. Sounds good to me. Cool. So the next speaker is Carl Harrison, and this talk is by him and his supervisor, Stefan Pasachi. Stefan. Okay. So if you've got any real complaints with the technicality of the work, you can mug that man up. I'm going to pass over to Carl. Thanks, man.
You know, make him throw me before the bus.
Yeah.
Okay, so the problem being attempted is identifying how effective the usage of support vector machines is to improve the usage of simple moving average to buy or sell over different financial markets. The reason for the importance of this research is simply to find ways to prevent monetary loss and increase the chances of monetary gain. It also gives an indication as to which commodity and which approach the support vector machines, along with the simple moving average, works best should someone want to implement the strategy. They would know which strategy to use and which market to make best profit based on past market trends. Throughout this presentation, I will be covering the following topics, as you can see on the slideshow behind me. To give more detail into the topics, I will discuss the model where support vector machines are used and how the walk-forward approach was used to test and train the support vector machines. Then different trading strategies will be discussed along with indicators used to train the model. Brief overview will be covered in the basics of time series data and financial markets and the different markets where trading can occur. And then finally, I will discuss the results of how the model performed across the different markets using different parameters. And then I'll follow with a conclusion and future work. A more concise problem description is as follows. Price history, together with technical indicators, are investigated as possible features to predict profitable trade opportunities in order to increase return on investments, making trading profitable. Support vector machines is a supervised machine learning technique that can be used for classification and regression challenges. In this case, it will be used to classify, buy, and sell signals. And it will put them into two groups, ignore and implement. So I will have two support vector machines, one for the buy signals and one for the sell signals. So it would have ignore if it predicts the price to hit the take profit, and then it will hit ignore if it predicts the price to hit the stop loss, and then it will predict implement if it predicts the price to hit the take profit percentage. Supervised machine learning refers to machine learning that relies on labeled training data. In this case, the labeled training data is the information if the trade was profitable or not. In this case, the labeled training data is the information if the trade was profitable or not, and the indicators at the point of that trade or that buy signal. The image demonstrates the way support vector machines work. It works by placing all the buy or sell signals on the plane with their coordinates relative to the indicators that were given at that specific trading indication. So these vectors are placed on the hyperplane, and then a margin is created between the two groups that allows for the greatest possible distance, thus dividing the two groups and maximizing the distance from the closest to support vectors. The one group is then seen as the implement group, and the other is seen as the ignore group. Note that at times nodes can fall on the wrong side of the plane, as financial markets are very inconsistent and often indicators give wrong indications. Once the training is complete, the next year's buy and sell signals will fit into one of the two groups created based on the coordinates given from the indicators. The mathematics behind support vector machines can be seen by the equations in the figure, where W is the normal to the hyperplane and B is the norm of W is the perpendicular, B divided by the norm of W is the perpendicular distance from the hyperplane to the origin. Creating an SVM or support vector machine is in essence selecting variables W and B that satisfy the given equations on the screen. So you may be asking me, why support vector machines? Support vector machines have been seen in literature to be more accurate and consistent than many other different machine learning algorithms in estimating whether the closing price in a time period will go up or down within a given day, specifically on Forex exchanges. And due to similar trends among different markets, I decided to test how this performed on different commodity markets that I'll go into now. Support vector machines is also a very popular used machine learning algorithm, and that further brings relevance to the project. And yeah, so then now I'll go on to the walk forward method that I used to train and test the data. So I started with the 1st of July, and I would train a specific model with 6 months worth of data. Each one of these intervals is 3 months long. So I would train it with 6 months worth of data and then test it for 3 months, and then train it a new model with 6 months worth of data and then test for 3 months. And what that led to is obviously a full year of results that I could use to decide what parameters to choose and where to go forward from there. I also decided to take, just to test it further and see how it performed on different lengths, I trained it for a period of a year from the 1st of July until the 1st of July of 2021. And then I tested it the following 6 months to see how it performed in that case. And unsurprisingly, the results were not as good because the data wasn't as recent. The training strategy used to create the signals for the model is the simple moving average. The strategy works by creating a second line over the closing price line, which is the average price over the last period of time, as can be seen by the blue line over there. And then the red line is the closing price of each hour. Every time the moving average goes from beneath the price level, as can be seen over here, to above, that's indicative of the closing price moving down, which is a sell signal in terms of the market, and that would go into the shorting support vector machine. And then when the moving average goes from above to below the closing price, that's indicative of an upward moving price, which would be a buy signal, or we would long the stock, and we would use the corresponding support vector machine. And as you can see, this is the case in most scenarios. The problem often arises when the price does not move far enough to reach the given take profit or stop loss that I will get into now in the following slides. So once again, you may be asking me why simple moving average? Well, moving average is known to produce both good and bad buy or sell signals, which means profitable or non-profitable signals. So it's known to give good and bad ones. And that highlights the use of support vector machines, because now we can see how support vector machines are able to classify the profitable versus non-profitable ones. Simple moving average is also a commonly used indicator, which further brings relevance to the research, as it's one of the most widely known indicators. And as well as that, simple moving average doesn't produce too many signals. And with support vector machines, the more inputs you have, the longer it takes to train the model. And yeah, so it takes longer to train the model. and my model generally solves it in about 3 seconds. So if you're wanting to retrain the data or trade on multiple markets at the same time, it's more effective. So that's why I also used a moving average of 1 day. I work with hourly data because it creates less signals, which isn't as difficult for the machine to solve. These indicators are part of the input along with the buy or sell signals. So each time a signal is given, the input is the indicators, as can be seen over here, which is the X input or the X vector, and then the Y vector is a 1 if a profit was made, meaning the take profit was hit, and then a 0 if a loss was made, meaning the stop loss was reached. So the 4 indicators are as follows. We have RSI, which is the relative strength index, where a high value corresponds to a sell signal, and then a low value corresponds, and a low value represents a buy signal. And then we have the moving average convergence divergence, which is also used, which is used. I use it by taking the difference between the faster and the slower exponential moving average as the input, and then that, with using that difference, I take a high value as a buy signal and a low value as a sell signal. And then third, I use the ROC, which is the rate of change indicator, where a high value represents a buy signal and then a low value represents a sell signal. And then finally, the last indicator I used is based off the naive strategy, where I take the difference between the current price and the previous price. And if that difference is positive, meaning the price went up, that's obviously means that the price is moving up. So that's indicative of a buy signal. And then if it went down from the previous price, which means it would be negative, that's indicative of a sell signal. So low value slash negative value. So all the data used in training and testing was obtained through Yahoo Finance. And then for those of you who haven't worked that much with financial data, I'll go through a brief overview of what you can find in those data sets. So I used hourly, so I obtained the hourly data for each of the commodities I'm working with. And in that data, you have the open, which is the open price in that hour. So that's the starting price of the relative commodity. Then you have the high, which is the highest price reached during that hour. You have the low, which is the lowest price you reached during that hour. And then you have the closed price, which is the last price that you have in that hour. And then volume represents the amount that was traded within that time span. And then dividends and stock splits obviously only apply to stocks and not things like Forex or cryptocurrencies. And then dividends is money paid from the company to its shareholders. And then stock splits is when the company makes more shares available to current shareholders. The indicators use this information to, along with mathematical formulas, to derive trends and to make predictions on movements in the market. And yeah, so the data is used from different intervals, and then in my model specifically, I'm using hours. The stock market involves the trading of stocks in return for currency over a specific platform. That's one of them that I'm using in the model. And then in this problem, Microsoft Corporation shares are used to test the model. And these shares are traded on NASDAQ, which is the National Association of Securities Dealers Automatic Quotation System. And then the second market I tested on is the commodities market, which involves the trade of currencies for assets such as oil, wood, and then as well as the one I use in this example, gold. Gold is traded on many platforms, but for this specific problem, I use the prices from the Commodity Exchange Corporation. And then finally, the last market I tested on was the cryptocurrency market, which is a relatively new method of trading. And in this case, I used Bitcoin to test the model. In this model, all three different forms of commodities were used in comparison to the US dollar. In this figure is a graph representing the value of the investment over a 3-month period. The investment starts with both the support vector machine and the simple moving average having a total value of $1,000 in the investment portfolio. In this example, only buy signals were followed, or the support vector machine for buy signals was used. So each trading method starts with $1,000. And the simple moving average one, which is the red one as can be seen in the graph, uses strictly, so every single time the simple moving average says buy, it buys the stock. And then the support vector machine works by every time the simple moving average says buy, then the support vector machine decides to implement or ignore it, and then it makes the trade based on that. So each time a trade is made, I use 10% of the current investment portfolio's worth. So if it's $1,000, then I'll use $100 worth, and then I use different ranges. So I have a 2% or a 1% take profit or stop loss. In this specific case, it was both a 2% take profit and 2% stop loss. As can be seen from this figure, my model is far less volatile than strictly following the support vector machine. As can be seen here, it moves a lot more up and down, which means that my model is less of a risk of losing your investment in a complete downward market. While at the same time, in a very much upward market, I won't necessarily make as much of a profit because certain buy signals, as you can see here, it was a consistent buy signal market where it was consistently profitable. And at certain points, my model decided not to implement those trades because it thought that they would be non-profitable. But as you can see, it's much more stable over time, leading to your investment portfolio being safer and less risk. So in each of the following tables, the results are given as accuracy is the percentage of correctly estimated calls on price movement in terms of profit or loss. And then all other values represent the value of the $1,000 investment at the end of the 3-month period. Buy long refers to the use of buy signals only. That means we only buy stock and then sell at the relevant stop loss or take profit signals. Sell short refers to the use of sell signals only. That means we only short the stock and then we sell at the relevant stop loss or take profit signals. And then finally, overall is just the average of the two. SVM represents the performance where the support vector machine was used. And SMA represents where the simple moving average was followed strictly. And then finally, naive represents a trading strategy where I combine the simple moving average and the naive method to see how that would as well. So how that works is if the simple moving average says to buy and the naive strategy says to buy, then you buy, otherwise you don't. So as can be seen here, in terms of the Microsoft Corporation share trade, overall accuracy was 52%. And then I slightly outperformed the simple moving average or the support vector machine slightly outperformed the simple moving average and naive strategies. And take note with that, that's the average using all strategies, including the strategies that aren't as effective. And at the same time, with that, half the trades approximately will be profitable, which means the support vector machine outperformed them with half the trades. So when taking trading costs into account, the difference is actually quite a bit more significant than that. And then using the top performing one, got an overall accuracy of about 57% there, and then 63% if you follow just the buy long strategy. And with outperforming the simple average and naive by $1 to $2. Moving on to the gold trade. This was one of the poorer performing ones. I found that was because gold is a less consistent, market than Microsoft, which the support vector machine struggles with, especially if the previous market is very different, or the previous 6 months, the movement was very different to the current 3 months that you test on. Then the model doesn't perform as well. So it slightly underperformed the simple moving average and naive. We also found with with gold, as it was also less consistent, it was also a lot less volatile. The 2% stop loss and take profit didn't work as well, but the 1% worked a bit better. And you can see that was the top performing strategy for that market. Finally, we move on to the performance for Bitcoin. Bitcoin was one of the better performing markets, where it averaged almost a complete dollar over using all strategies. And then if you took the top performing strategies, they outperformed both the simple moving average and naive quite significantly, even though the accuracy was generally low. And the reason for that decreased profit was obviously I was using a stop loss of 2% and a profit, take profit of 1%. So you'd approximately need to make 2 profitable trades to make up for 1 loss trade. So yeah, that's why I performed in that manner. So yeah, to conclude, based off the results, one can see that the use of support vector machines to predict movement in financial markets is effective, is often effective in outperforming common trading strategies. One can see the improvement is apparent across the different financial markets, with the exception of gold in this case. And then certain strategies outperform others in different financial markets. So fine-tuning of the model according to the financial market you're trying to trade in is essential. And then finally, with some potential future work I'd like to go into, is with more testing across different markets and more frequent train and test durations, and fine-tuning of the parameters, the results of the model can be improved, and the accuracy can be greater and increase profits. So I'm talking about retraining the model. I also mentioned here retraining the model even hourly, with more recent data, maybe a shorter time span of 2 months or 1 month, and then you retrain it every hour, you would find improved results. And then the use of more indicators can be used, or 2 indicators at once to create those buy or sell signals could also be something that could improve the model quite significantly. And then just an effective way of parameter testing, since there are so many parameters to look at, I had to sort of minimize it to the stop loss and take profit parameters, but there are really very many parameters. So to find a more suitable solution is definitely possible. Thank you.
Thanks very much, Carl. Before I get stuck in, any questions? Yeah, let's do it.
I've got quite a few, so I'd be happy if someone else would go first.
We'll play ping pong. You go one, I go one, and let's go from there.
First of all, excellent, interesting presentation. I suppose for 2 reasons at least. First, we're from first hand, so I hope RMB has contacted you yet. Otherwise, we should talk. Secondly, I have a keen interest in SVMs myself. So perhaps let's start with some of those questions over there. Your choice of kernel, what was it?
So I used the RBF kernel.
Radial basis. Was there scope to experiment with some of the other kernels? Polynomial and
yeah, so I experimented with polynomial quite a bit as well, and then linear just didn't work at all, just because of the way the indicators sit. Polynomial worked as well, but I found I had to use. Are you familiar with the new value? So it's the lower bound and the upper bound of the amount of vectors that can be on the wrong side of the hyperplane.
Okay.
So with polynomials, some examples I had to use very high new values because it really struggled. to find a hyperplane that fit, which almost made the testing random. So I found RBF worked the best, and in literature, especially with financial markets, I saw they recommended RBF a lot from what I saw.
So that would depend on which library you've used exactly, because SVM they cater for new regression and new classification. Those formulations of all these kernels, but it's not on by default. And I know there's another one that uses the new classification by default. Can't remember exactly. I think it's Kernel Lab, something like that in literature. But which package did you use this? Was it Python or R?
So I used sklearn in Python.
I'm not familiar with. I'm much more of an R guy myself.
Yes. Python people drive us insane.
Okay, so since you've used a radial basis function, then from my own work, do know that choice is quite sensitive to the measure that you choose to target in Optimize, especially during the training of the hyperparameters. So just to simplify it, what did you choose? Was it mean classification cost itself, or?
So I'm going to be honest with you. At this point, it sounds like you two need to have a coffee together.
Perhaps let's do that then.
No, I think so, because you're diving into very good, and these are fantastic, but we do have to give everyone a quick break to stretch the legs before the countries talk, which is next.
I see.
So I think we can thank Kyle for an excellent presentation at this point. And then we're all going to overhear the conversation you're going to have here that is the next one.
Lunch is fine. Everybody calls me. No one calls me.
Time out, because we're eating into countries. Welcome back, everyone. I hope you enjoyed that. We get to enjoy some more. Our next speaker is Kanchu, and he's going to be talking about the title over here. He said the talk's very boring. You should have left. His words, not mine.
It's true. He's not lying. So what I'm going to do is I'm going to talk about banking, especially, right? So in consumer lending. When banks lend out money, they also have to retain certain regulatory capital. And the reason for that is really, you can think of almost like the solvency versus bankruptcy. So if you keep some money, retain some capital, and if your depositors in a bank come and they have a bank run where they come and they try to withdraw all their deposit, you have, sorry, I'm saying it wrongly. If people don't pay back their loans, and you don't have enough money for them to pay back the savings, then you're going to go bankrupt quite quickly. Right? But not everybody stops paying your loans at one go, right? So they've worked out a system where they say at least they've got to protect the bank at 99.9% of the time, where the banks are safe because the banks hold on some capital, and when people don't pay back, they've got this capital that they can use until they can dig themselves out of this mess, right? And we saw during the financial crisis where banks needed more capital because there was a less repayment back of loans. And so what I want to do is talk about in consumer lending. So when you lend out money, you've got to retain some capital. There's a cost to retaining that capital because you could use that capital in other instances, right, to fund other activities. So you've got to incorporate the cost of that capital when you make a decision on giving somebody credit or not. And so let me set out the scene. So suppose you have a portfolio manager who's got a pool of loan applicants, and they've also got a scorecard to score these applicants. And you've got a scorecard before in what they call credit scores. In making these scoring decision, each person can be scored, and you can more or less then decide whether to give somebody credit or not based on your objectives. And you could have multiple different objectives. And what we want to do is take the concept of capital requirement in making this decision, because not whether the applicant is profitable or not anymore, but also the cost of taking that applicant onto your books. So regulatory capital is capital acts like a financial cushion against losses. I'm just reading that off. When, for example, many borrowers are suddenly unable to pay back their loans or some of the bank's investment fall in value, the bank will make a loss. Without a capital cushion, might even go bankrupt. But if they have a capital cushion, then they could use that cushion, and it also gives them some time to get themselves out of that mess, right? So we assume the portfolio manager has access to the pool of capital when making this decision. So they could allocate some of this capital against the lending that they're going to do. And so portfolio manager always, when they do lend out, they will make sure they're adequately capitalized, at least based on what the regulators say, right? So regulators have a formula, which I'll talk about later, which determines how much you keep for different consumers that you lend out to based on their risk profile. And portfolio managers might have many objectives. And so you could think of a portfolio manager might want to maximize profit. That seems like an obvious one. They might also want to maximize volume or market share or minimize losses. And in our work, we only focus on profit and volume. So profit and market share, right? So if you have two portfolios or potential portfolios, which will yield the same expected profit, but the one's got a higher volume, you rather take on the higher volume than the lower volume, given the same level of profit. So, I'll talk about a concept of efficient frontier later. And the portfolio manager's got to make two decisions: accept or reject an applicant, and how much to, whether to reject them based not only on whether they're good or not, but whether you have enough capital to adequately capitalize them. Okay, so let's go through some basics of setup, which Oliver and Wells had done back in 1980 something, on how he thought about it. So when you give credit, you have a credit score, right? Or you can score an applicant. That credit score can be mapped onto the probability scales to decide the probability of default of an applicant. So they will either default or they won't default. If they don't default, you'll make certain amount of money from giving out a loan to them. So if you give 1 rand of loan, you'd make 1 plus RL back from them. And if they don't pay back, then you lose the full money that you might have given out to them, or you can assume that you can reclaim some of that money back. So for each applicant, based on their score, you can map in the probability of default, and based on the probability of default, you can work out the expected profit of that applicant using this simple formula. So if you think about scores as, let me point. That point? No, that doesn't work. I don't know how to use the red.
The laser doesn't work.
Oh, it doesn't work. Okay. So if you think of the red line, that's the score, right? And the probability of default is on the y-axis. So the higher the score, the lower the probability of default. That's the way credit models are constructed, and that's kind of a standardized way of thinking. So if you think of a probability of default going down monotonically with scores, then expected profit will go up because there's less chance of the person defaulting. So that's also monotonic, right? And so what you can do is, if you had a whole lot of applicants and you could score everybody in terms of, you could score everyone and you could work out their probability of default, don't worry about all the writing. So I'll just explain what happens there, right? What you could do is you could line them up from highest, probability of default to lowest probability of default. And then if you had to give one person credit, you take the person with the lowest probability of default, because they'd have the highest expected profit, right? And then you keep on going down that line. And if you had to plot that, if you take the one person, they'll be somewhere around there. By 0, 0, if you take the next person, then you'll get a little bit more profit. Your volume will increase a little bit more. And if you keep on going down the line, you're going to reach a point where the profit of that person is going to be equal to 0, right? And that will be point W, where the score would indicate expected profit of 0. And this is for the portfolio. You've taken everybody above that score. And then anybody you take in after that into your portfolio, you start decreasing your expected portfolio profit because they have negative profits, right? Okay. So in a case like this is portfolio profit. This is individual profit on the left-hand side. The right-hand side is portfolio profit. If in a case like that, if you wanted to maximize your profit, you take everybody and cut off at W. Right? So you'll decide that's the point that is profitable, and you take everybody with the highest score than point W. Right? That's if you want to maximize profit. But remember, we're talking about maximizing profit and volume. If you wanted to maximize profit and volume, your efficient frontier would be from W to Z, right? Because at any given profit point on the red line, you could always find another point with the exact same profit, but higher volume. Right? So if you're a portfolio manager, you'd always operate between W and Z. And that's called an efficient frontier. This doesn't take into account cost of capital, cost of regulatory capital. Right? And so this is the historical Basel equations for Basel capital requirement. If you have portfolio, if you have a zero portfolio profit, you have to retain zero capital for that. I mean, sorry, zero probability of default, you have to retain zero capital for that because there is no uncertainty there. Same thing with one. If everybody's going to default, then you don't need a cushion because there's no uncertainty, right? The regulatory capital is only, you keep capital for uncertainty. So it's only somewhere between 0 and 1 that you have to retain some capital, and you see the capital kind of increases and then starts decreasing again. Right? And there were, back in, I don't know when it was, 1988, the level of capitalization was flat. It was 10% of what you gave out. Then in about sometime in the 90s or early 2000, the changes such that, a bank could either operate on the blue line or the black line. If you're a bank of high importance, you could operate on the black line. If you're a small bank, then you could operate on the blue line because you just didn't have the infrastructure to determine all the things that you needed to do to operate on the black line. But the black line is really the more interesting one, right? So for different levels of risk, you've got to retain different levels of capital. And so if you had, if you had no capital constraint, you had all the capital in the world, and you had to decide how much to keep and what your efficient frontier looks like. All it would be taking the Z line and kind of dropping it down a little bit, right? Because the cost of capital increases as you go from left to right. So that whole curve that you see, the blue curve, which you saw earlier without any cost of capital, would just, the profit would decrease because now there's a cost of capital, and the cost will increase monotonically. Therefore, it's just kind of like pulling it down. And when you pull it down, there's still a maximum profit cutoff point, and you can work out your efficient frontier there too. So it's the red line. It's the expected profit with capital costs. Okay, but that's if you had no constraint on capital. But if there is a constraint on capital, then you've got to start making a decision on, who you should accept into your portfolio. And so what I'll do is I'll give you an example. I hope it's the next slide where you could, okay, it is the next slide, where you will see why it's no more a single cutoff point. You can't just line up your applicants and then take the top best applicants, right? Because remember the thing on the efficient frontier, and I'm going back a slide, is the last point on the red line is the highest volume point, right? And the highest volume point is generally accept everyone, right? But now you have capital constraints, so you can't accept everyone because you don't have enough capital to cover for everyone. Right? So what is the maximum? What is the highest volume point if you take capital constraint into account? Because you don't care about profit; it's just the highest volume point. Would be to take everybody with the least amount of capital requirement, right? And the least amount of capital requirements are found at either end of the risk scale. So if you had to line up people from high risk to low risk, the people at the last 2 points would have the least amount of capital requirement because there's so little uncertainty about them, assuming they have absolutely high risk, close to 1, probably a default of 1, or close to high risk, close to 0. So the highest volume must be taking all the people at the end until you meet your capital constraint, right? So therefore now it's no more a single cutoff point and you take everybody above a cutoff point. There's 2 groups of people that you have to accept. Right, that tells you it's not a single cutoff score strategy anymore, and it's got a 2 thing. So in order to build an efficient frontier, what we could do is we could use simulation, right? I mean, all people like using simulation. It's an easy way to do stuff. So what do? You kind of you have a population of people, you take some people, you work out the expected profit, their cost of capital, and you can see how many people are in that group, and then you can plot a point. You can keep on doing that. But this is quite difficult because if you talk about in a continuous scales, how do you determine how many groups of people do you take, right? I mean, do you take 5 groups in intervals, or do you take 10 intervals, or do you take 9,999 intervals? So simulation is not as easy as one would imagine, because it would just take a long time to determine the efficient frontier. Right? And these intervals, if you think of a continuous scales or probability of default from 0 to 1, we could talk about small intervals versus big intervals. But maybe there's a more systematic way to calculate the efficient frontier, which I'm not going to show, right? Because the math is weird. So first of all, I go back to the EPV curve. I call this the EPV curve, the red curve, right? Without any capital constraints. And I noticed that anyway, if capital constraint is hit at the point A, then all the points less, on the left of A has capital requirement less than what your capital constraint might be, right? So if something is the highest profit for a given volume without capital constraint, and that capital constraint is less than what you require, your capital constraint amount, then that must be the highest volume even with the capital constraint. So I know my EPV curve from 0, 0 to all the way to A is already mapped out. Then I know the highest volume point. It's kind of easy, right? So I just take everybody from the left and the right-hand side. I can map that out, right? So that'll be point B, it's the highest volume point. Now the difficulty is mapping up all the points between A and B. Right? And if I could map out everything from A and B, then the highest profit point over here all the way to B would determine my efficient frontier. So instead of going through the math behind it, I'll just show you how we do it, right? So if B would be everybody we accept all the way up to here, right? So everybody online can't see this. Let's say it comes up to here, and A was everybody that we accepted all the way here, right? Everybody with the, let's say, probability of default less than 0.6 for argument's sake, right? And that was point A over here. And point B would be, let's say, everybody between 0 and 0.1 and 0.9 and 1 for argument's sake. So the way we determine every single point between A and B is we gradually start decreasing everybody from 0.6 going downwards and start filling it up from either side. Sorry, from the right-hand side. So we take it, we reduce the highest riskiest people of the left-hand side that you've accepted, and we start increasing it with the lowest riskiest people of the right-hand side, which are quite high risky people. And if we keep on doing that, we'll be accepting here and we'll be decreasing here. We'll come to the point where they start meet up, and that will be your last point. That will be your point B. And that helps us fill all the points between A and B. And once we've done that, we can determine what the efficient frontier is and where the bank manager needs to operate. If they have a capital constraint and they want to operate in the point between expected profit and expected volume. Right? And so what we try to do in this research is, assume a bank manager is trying to maximize profit and maximize market share. We showed the case of a bank manager who has 0 capital constraint, and we showed how it's quite easy to then determine the efficient frontier. But then when we wanted to think about a bank manager with a capital, with a real capital constraint and can't just accept all potential applicants and grant them credit, there is a different strategy that we have to do. Right? And that strategy we couldn't solve using simulation, but you can do some mathematical gymnastics and you could figure out that you can map out the efficient frontier. And it turns out that all efficient frontier either a single cutoff score, right, where you cut off somebody and you accept everybody bigger than that, higher scores than that, or it's a double cutoff score strategy where if you have the people lined up, ordered based on risk, you cut off in 2 points and you accept everybody who's greater risk on the one side and lower risk on the other side. And we call that a double cutoff score strategy. I don't show you the proofs because the proofs is quite complicated, but it's in our paper, and that's all, folks. Thank you.
question. Back on time, we've got the floors open.
So first of all, very interesting presentation. This is very close to my own set of research in questions. I would very much like to take this offline.
Sure.
Learned his lesson now.
Just covering my bases, you see that. Perhaps just a quick remark. So that curve that you've showed from Basel II, by the way, that's Basel II from 2006, both the standardized and the
2.5.
Yeah. So that's based on the Wassercheck's formula itself, giving the stressed PD itself. But of course, and then perhaps just on here, you know, it was originally devised for 1 in 1,000-year event, but it seems we are having those every 4 years these days. So I'm not too sure about the applicability of that anymore. Have you considered how this would interplay with macroeconomic covariances and how the system keeps on changing over time?
So yes, it's a simple answer. So remember, this study wasn't about the Basel itself, right? It's about the decision making given a regulatory formula. So there's work done by Malwandla at UCT, so he was a PhD student of mine, who incorporates macroeconomic factors in creating a Basel-like formula that incorporates, you know, future macroeconomic. Well, I think what he does is I can't remember fully now, it was my students, but I think the one method he incorporates current macroeconomic factors only. So it's a point in time. And then he does talk about another method that takes forecasts of macroeconomic events into account as well. But then prior to him having done that, so he did that for the regulatory capital requirements, right? Prior to doing that, we did somewhere, in fact, it was the first paper from my PhD, which talks about how do you make a decision given that you have to make a decision now, but the way things play out is in the future, right? And so you've got to expected, let's say you know the expected probability of different scenarios.
That changes everything, basically.
Yeah.
The future is so uncertain.
So there we assume we know the distribution of the future, right? But it's very hard to know the distribution of the future, right? Yeah. But the first stab at a problem is if you assume you can know what the distribution looks like, and then you make a decision on that, and then the next step would be on making multiple decisions. In fact, the follow-up, I should say, the follow-up to this paper actually takes future macroeconomic, not future macroeconomic, but future changes into it. And that changes could be macroeconomics or other factors.
Okay, because perhaps it's a link. I'm not sure if this would be relevant, but so this first of all sounds very close to the notoriously difficult profit scoring problem instead of, you know, the usual care score from Thomas 2002.
I don't know his paper. Oh, Lynn Thomas.
Yes.
Yeah. So he does similar work to this. Yeah.
Well, he did.
He did, yeah.
Unfortunately, yeah. But instead of the Basel kind of framing of this context, would you consider IFRS 9, which is much more, you know?
So I don't know IFRS 9 well, so I've kind of left this research area a while back. But I think IFRS 9 takes, I mean, if there's any accountants here, they could takes more point in time, and this one takes through the cycle, right? Or the other way around. There's a nodding of head there. So I don't know it quite well, but there is a difference between IFRS 9 and Basel in fundamentally the way to think about risk. Yeah.
IFRS 9 expected losses, Basel, the 1 in 1,000-year unexpected losses kind of.
But also a point in time versus through the cycle, right?
The only reason why I'm suggesting that, and I'll finish off quickly. I can see you starting to.
You don't want to upset Roberto.
We do want to include, you know, fireworks, and want to make this realistic. You know, and use macroeconomic covariance and how this whole system is constantly in flux, basically. Then IFRS 9 would allow you much more, you know, accurate characterization of reality, and then, you know, your eventual profit function, and then you want to, you know, that kind of.
So that also depends if you're trying to model for IFRS 9 or Basel, right? So in one of our papers, which is not published, the reason why it's not published is because we talk about both IFRS 9 and Basel in the same paper. So it's one by Musa Malwandla for his PhD. And all the reviewers have come back is saying you've got to either stick with Basel or with IFRS. They don't want you to confuse the two, like put the two together.
That's quite weird. We're doing that now in first.
Send it to your journal then.
Perhaps this is time for collaboration. But excellent presentation. I'll stop there.
You've still got time. Would anyone else like to ask Prof. Kanshi anything? I know Stefan had a question there at the back. Okay. I saw a twitch. I wasn't sure. I've got a question on this. I mean, often when I look at the way when you talk about, you know, you've got a particular expectation. So I originally come from a stats background, and one of my favorite courses was extreme value theory. And it was because it addressed a fundamental issue in the financial sector around how when you start to pull these events together, everyone's like, oh, don't worry, central limit theorem will be fine. And put it together and you're like, Brownian motion, no problem, 1988. You know, so there's a lot of assumptions that go into these things that aren't necessarily representative of the way in which they actually behave, right? So you don't hear people complaining that, oh, that was the 1 in 400 year flood level line. It gets crossed every 4 years. No one has that conversation because a proper sense of mathematics is applied there, right? In those kinds of human life critical situations. So there's a lot of attention paid to that mathematics, right? To make sure that we don't have millions of people drowning every year because of flood levels, right? But you find in the financial sector, at least I've seen, and I'm not judging, this is a safe place. Often there is this reluctance to do the harder math and to simplify things down a little bit. But often in that step, you're condensing a lot of the volatility, and then you get the situation that you're describing, right? But it's inconvenient. So there's a trade-off where we don't mind trading off financial assets. We don't treat them as valuably as human lives, right? But we trade them off for simpler math.
So I don't think that's necessarily true in research. I think what is true is in banking practice, because the incentives are for 1 year. Bonuses are paid in 1 year, right? They're not paid over a very long period, except for maybe a CEO who gets options.
Perhaps the CEO got paid 122 million rand last year.
Okay, so then maybe it is a very short term, right? So that adds to what I'm saying. So I think the problem is incentives. So you play on the risk, right? And in fact, there's incentive to take on high risk because things do really well, you make a lot of money, but the worst you can do is zero. But I think if you look at the banking literature, you would see the kind of the stuff that you're talking about. Sunday also had a question. I don't know. So I just want to introduce Sunday. Sunday is kind of the lead in the special interest group for data science. So if you have any interest in data science for with the special interest group for ORSSA, Sunday would be a good person to speak to. Sorry, I'm putting you on the spot there.
Thank you very much, Kanchi.
Thanks a lot.
And it's tea time now. And don't forget, there is another quick 1.5 hour stream after this. And then you're allowed to go and party. I understand. So yeah, thanks everyone.
And